Hello and welcome to a brand new episode of ET Markets AIF Talk, a show where we discuss the opportunities as well as investment strategies deployed by the fund managers in the popular space of ultra HNI investing. Well, my name is Shadajan and today we have with us a very special guest, Mohamed Irfan, who's a fund manager at Vivriti AMC who manages over 2,200 crores in AUM. Welcome to the show, Irfan.
Hi, thanks Shitesh. Thanks for having me.
Thanks for being part of the segment, Irfan. Now, Vivriti has a wide variety of funds catering to the credit market. Tell us a bit more about the mid-market performing credit space and how you're addressing the financing gap in India.
Sure. So, the mid-market space has been catered to in various forms and manner over the last 10-15 years. Largely, you would have seen banks have mid-market books. You would have seen some NBFCs, wholesale NBFCs operate in that space. So the term is not new. What's happened is that after the credit crisis that has happened since 2018, a lot of them have sort of dialed down or vacated the space. So that is where the need for alternate capital comes up, and that's the space that we as Vivriti Group and Vivriti AMC sort of address. Now, the way we do this is to go after companies which have a good amount of vintage, are largely profitable, and their business model is quite proven. So that's the cogs of the Indian economy, right? So it's away from the startups and the stuff that grab headlines. The vast majority. So we have about more than 4,000 odd firms which we've kind of narrowed down, and totally about 10 lakh crores of debt that is actually being deployed in these mid-market companies, which is our target segment, which is where we invest actually.
In fact, I was going through the fact sheet and you deployed more than 2,200 crores in various credit strategies and raised more than 3,500 crores of commitments till date. Now, investments have been made across various sectors such as energy, infrastructure, SaaS, as well as logistics. How has performance of your funds been so far?
Right. So, in terms of the strategies that we, deployed, the ones that we're talking about for this 2,200 crores, all of them, of course, have been so far so good. We've beat hurdle in all of our investments till date.
Right.
As a fund house, we've had no days of delays across any of our payments. Given the kind of time period we have been in the cycle, it's something not too many people have. Also, as a group, we have kind of built we like to go for diversification. So every single fund that we have is amongst the most diversified you can see within the private credit industry, right? And the other bit is about risk, which no one actually talks about, because and the way to objectively look at risk is that if you're having a rated portfolio, as in all your companies have a credit rating, one way to look at it is to see what is the upgrade downgrade ratio, right? So how many companies have got upgraded versus how many have been downgraded, right? And the ratio of that is usually a decent barometer of what sort of risk that the portfolio is running. More than the descriptive parts, which of course every fund manager would put out, but just the upgrade downgrade ratio, we have overall as a fund house experienced a 3.2 times upgrade to downgrade ratio, which means for every downgrade we've had more than 3 upgrades, which is much beyond what the industry upgrade to downgrade ratio is. So that's broadly to put our performance in perspective.
No, absolutely. In fact, we'll talk more in detail about risk management strategies that you deploy, in the fund. But before that, take us through the investment strategies of the fund house as well. So, how would you compare this with the other strategies deployed in the market as well?
So within the private credit space, first this space typically operates between 10% to about 17 to 18% of return, right? And most people use that as the only barometer, like I say. And again, I'm reiterating this point that we have a risk-first approach of doing this. So what we do is that we try to benchmark our risk first, right? So that's where is it that you want to play, not on the yield bracket and then on the credit risk bracket, right? So we try to do that first in terms of whatever strategy we want to deploy, and then we try to build a product which brings additionality to both the investor as well as the investee. So what that means is that if for example I'm saying that, all right, there is a strategy where I can deploy in very, very high quality companies in the 12 to 13% yield, and this strategy is about 2,500 to 3,000 crores of opportunity right now, then I'll see that, okay, fine, can I have a fund which is 20 or 15% of that, right? A 3 to 500 crore strategy where investors have not had an experience in investing in those companies before. So it's an additionality for the investors, and it's an additionality for those companies because they've not had investments from capital markets before. So where there's an additionality of some sort, that's where a product and a strategy kind of finds a fit, right? It's like a product market fit. And the number of strategies that we've run till date, Kshitij, we can broadly define them into two buckets, right? So one is what we call the blind pools or the diversified strategies, right? So there we are trying to say that so investors underwrite our ability, our experience as a private credit manager, and they say that, okay, fine, take my 2 crores, take my 10 crores, take my 50 crores, and manage it the way that you've always done. So that's one set of strategies, right, where the diversified funds actually fall in. The other set of strategies are what we call thematic strategies. So that is where the incoming investor has a particular objective that they want to reach, right? So it could be something to do with impact, it could be with a market development strategy, it could be with something like a new asset class such as securitization, right? So these are thematics. So that's the second umbrella of strategies that we run. So each of these strategy has multiple funds in there, and together is what constitutes the 3,500 crores of commitment and 2,200 of AUM that we are actually running.
No, absolutely. It's a very interesting space. In fact, when I was going through the fact sheet and the other material on the website, we also find it very fascinating, and something which is more recent to the credit market as well, or to the securities market as well. And there comes my next question to you. How's the investment culture sort of shaping in India? Are more HNIs or family offices open to investing in a bond fund, or this avenue is largely chosen to diversify investments? So why I ask is that is there a maturity that you're seeing in Indian investors as well, vis-a-vis let's say the global investors that we see?
Yeah, this is a bit of a mixed bag, to be very honest. So that has always been an allocation to a lot of investors, but after the last 4-5 years, a lot of them have it's a bit of once bitten twice shy kind of an approach. So most people have kind of
there are always recent memories to a lot of things.
Right, and it's a bit of most people who have been burnt by this kind of move to a bit of a barbell strategy where they say that I'll either keep in cash or I'll go all equities, right? So that variety is that set of investors are still there, right? There's the other sort of investors which have kind of emerged, which is the more sophisticated kind, where they are looking at playing an allocation game. So what they are trying to see is that, all right, I've got some money for my, depending on how they plan, 3 months, 6 months of liquidity and so on, and then I have my AAA bonds. But before I start making an equity allocation, I'm going to traverse that path of taking incremental risk, right? So they're going to say that I'm going to invest in products which probably give me 10, 12, 14% kind of returns, more fixed income like, and before moving on to the higher equity risk kind of products, right? So it is in that space where products are very less, and those are the investors who who are typically most excited about our products. Now there a lot of family offices and ultra HNIs are doing this as a strategy as we speak. It's a lot of convincing and evangelizing the asset class that had to be done for people to understand the kind of risks that you're taking for the return that you're getting. And I think that along with the industry, now that you're seeing that there's so many private credit players coming into the market, so it's got that critical mass, though we've been there for the last 6 years deploying through this crisis. I think now that understanding is there, and over the next 2-3 years, this culture will only become stronger. However, the only caveat I would add is about understanding risk, where I still feel that it's still quite low. It's still very return focused. It's still talking about whether it's a 12% fund or a 15 or a 17% fund, rather than objectively trying to measure what the underlying risk is. That culture is still not there, to be very honest.
Absolutely, and my next question is related to that. So take us through your risk management strategies as well.
Yeah, so I've said risk a bit too much during this call, but that's typically what defines the way we work, right? So because we believe in, for example, before we enter into any investment, even though it's a credit investment, make sure that the macro is right for that sector, right? So typical, question of being in a good house in a bad neighborhood versus being in a good in an okay house, is the same analogy, right? So make sure that the neighborhood is good, and so research is probably the first bedrock of, sound research is probably the first bedrock of a decent risk management strategy. So you know where you're going. The second important part is how you go about assessing that risk, right? And here we are distinct in saying that one of the very few players in the segment who does entire due diligence in-house. So typically what happens is in private markets, Kshitij, and maybe for you viewers who might not know, due diligence, the process of researching companies bottoms up, is done with the team along with consultants, right? So you would have guys like the Big Four, some consultants who are specialized in doing the financial due diligence, the commercial due diligence, the legal due diligence before a private deal is sort of done. We in-housed all of that, right? So we have amongst the largest credit and risk teams in the industry, 20 just in the AMC, and overall as a group about 65 members in the credit and risk team. So we make sure that everything is done in-house, right? So we see all of the data points, we do all of the meetings ourselves. So to that extent, very high amount of conviction is built through the process. So the assessment of risk is where we delve deep into. And the third is, of course, once you take on the risk, how do you manage it, right? And that's again where our monitoring, post-investment monitoring comes in, where again we make sure that every quarter, our investment thesis is revisited and revalidated by doing on-ground due diligence, right, and monitoring activities, and we make sure that all of that is transparently disclosed to our investors. And the last part is what happens when you're facing any issues with what you're seeing, right? You're monitoring and then you're seeing something's not great. It's also about exits. So, where you need to have slightly structured documents and covenants so that you can exit an investment which is not making sense for you. We have a track record of being able to do that very, very effectively, so that the portfolio is always in the pink of health and we do not get carried away with the fact that, oh, this is our deal, we've done this. ठीक हो जाएगा सब कुछ थोड़ी दिन में. So that's not the approach we take. It's a bit more of a very dynamic approach where we exit investments much beforehand if it doesn't stick to our investment thesis, right? So that bit of being objective about it is the fourth part and the most important part. Most people fail that, right? Every single corporate failure you see where there are debt investors or even equity investors, very, very hard to believe that they do not know what's happening. It's just about एक कदम और kind of a thing, right? That's really what's caused a lot of problems. So that's what we stay away from when we manage risk.
Right. So does interest rate cycle also impact funding?
So see, rate affects you in two different ways, right? One is in the vehicle that you're operating in. So for example, very close example is mutual funds. So if you're taking a mutual fund, you put in, 1 crore rupees there, and then the interest rates start to rise. So regardless of what your investments are, they're going to see a mark down in value, right? So because of the duration risk that you're running, you will see a loss investment, mark to market loss in investments, and vice versa. So the interest rate actually affects your returns in a very direct and tangible way. So this is if you're in a vehicle which is exposed to interest rate risk. Now at Vivriti AMC, we operate only close-ended funds. Till date, all our funds have been close-ended, which means when you come in, you're not really exposed to the MTM of interest rate volatility. So if it's a 3-year fund or a 5-year fund, the vehicle in itself does not expose you to interest rate risk. Right? So that's point one. The second way, so that way our products are not exposed to interest rate risk. Now the second point is it derives from two corollaries, right? If the product is not exposed to interest rate risk, how can it be that interest rates are rising and you're not actually having any loss? There's a little bit of a play there, Kshitij, because what happens is that when interest rates are rising and you want liquidity, that's when the MTM comes into play, right? If you've come into a closed-ended fund today, 2023, and you're taking a 5-year call, then that interest rate call is already implicit in your investment,
locked in,
right? So you've already taken that 5-year call, right? So in 5-year calls, for example, if interest rates are go up to, just for example, if GSEC goes to 10%, right? Today it's 7%. So from there it goes to 10 or 11%, for example. Your returns are anyways going to be much lower in this fund because it's not like a GSEC plus 500. You're not going to get an 80% return from a 12% fund, right? So it's already implicit. So that's the pro and con of coming in a close-ended fund. Now the second point is whether your investments are actually going to be exposed to interest rate risk. Forget the vehicle. The vehicle is the first part. Part two is the investments. So what do you do there? So you make sure that you invest in companies where interest rate sensitivity to PNL is quite low, right? So how does that happen? That happens when you're investing in companies which are actually running lower leverage. That's point one, right? Because a highly levered company, more debt, even a bit change in interest rate, yes, that's one. The second bit is whether that interest rate can be passed through the revenue or not, right? So whether this typically plays in financial services companies where you're having a liability which is floating and fixed versus an asset which is floating and fixed, and a percentage of that is something that needs to be closely monitored. So we make sure that we manage the interest rate sensitivity on companies where the revenue and the expense are both linked to interest rates, and on the side of companies where interest rates will matter in terms of cost of financing, we make sure that we back companies which are much lowly levered in an interest rate rising environment.
Okay. Absolutely. Now, another thing we wanted to understand from you is that how is the wealth management shaping up in India, especially after COVID? Do any recent trends sort of stand out according to you?
Right. So, COVID has been a bit of a wake-up call in many ways, right? One sort of a wake-up call is the underlying risk that people were sitting on, and how they've not been able to exit. A lot of people lost money in some parts. The second part is also about missed opportunities. So people who did not, and this is a lot more today, right? In hindsight, people who did not enter in May 20, people who did not enter in 2020, lost a large part of the upside. So both of it is there. So it's a bit of a wake-up call on both sides, right? You're not taking risk and being exposed to the wrong kind of risk. So for the sophisticated investors, the high, the UHNIs and the family offices, I feel the one big trend is about formalization. It's an approach to a lot more of formalization in the way that they allocate assets and kind of go about their goals of the family office or of that UHNI per se. So that gives a rise to a lot of demand for sophisticated advice by wealth platforms, right? Or wealth advisors, that whole ecosystem, which is why you would see post-COVID, not only have markets done well, but the wealth industry per se has also done very well in terms of increasing their AUM. Now, that formalization and that increase in wealth AUM also means that there is a need for products to be serving that, which is where, that's the virtuous cycle that we are in currently. And this is a bit of a long-term trend, right? This is independent of market cycles. So even if there's a down cycle, yes, it depends on how your asset allocation is, how defensive it is, and so on and so forth. So that bit is becoming a lot more prevalent. Even if you see mutual funds and open funds, they're launching fund of funds, they are launching asset allocator funds. So this bit of asset allocation, this bit of formalizing how you're going to manage money beyond a certain point, that's becoming a lot more mainstream. I think that's just one key defining part cutting across post-COVID, I would say.
No, absolutely. It's quite relevant and we are seeing it very evident at this point in time as well that, investors are taking wealth management more seriously than they were doing it, before COVID. But that's a welcome sign to every industry, I would say that. Now, who should ideally invest in your fund? What's the kind of time horizon which one should be looking at? Although you've answered that in bits and pieces in the conversation above. But yeah, ideally, if someone is looking at investing in the fund, what is that one thing he or she should ideally keep that in mind?
Right. So first is what part of the allocation comes here, right? So when we're looking at performing credit, the space that we operate in, where we're clear to say that, it's debt risk, where we like the investor to say that, okay, the money that you're putting in here is not the money that's going to earn you equity-like returns in a debt form. It is actually going to be more stable, predictable, but definitely low risk and a bit lower return. So that's the allocation that has to come here, right? So typically the allocation that comes here is not growth capital. The allocation that comes here is the money that, for example, you money that you don't need for 3 years, money that you don't need for 5 years, but you want that money to be safe, and probably you want some cash flows coming from that, probably in terms of accrual, right? Coupon payments and so on. So in a very, very broad sense, and a UHNI who's looking to allocate will, depending on his age, will have 10 to 20% in alternates. Within that 10 to 20% in alternates, there would be an allocation to private equity, maybe to venture capital, and then there is an allocation to debt, which probably can be about 5 to 10% of that portfolio, right? So that's where we find this space to be in. Typically, credit cycles are 3 to 5 years long. The mega cycles are, a bit longer than that, about decade, 10 years. But the smaller cycles are 3 to 5 years long. They can be getting shorter as we speak, but 3 to 5 years is a good space to be in. So it's very difficult for me to sit today and think in a mid to high yield debt return strategy, a 10 or a 15-year view. Right? It's very difficult for me as an asset manager. So you'll never find a 15-year product or a 10-year product giving high teen yields from Vivriti AMC. What you will find is 3 to 5 year products where investors would be able to just park their money in, get stable returns, and then move on with whatever their life goals are. That's typically what the allocation should be, I would say.
Well, on that note, thank you so much for your time at Fun, and that's all for now. But do stay log on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.